Good afternoon, everybody, and welcome to all of you joining from YouTube or LinkedIn. I am Nuno Fernandes, Professor of Finance here at IESE Business School. We try to make these sessions as interactive as possible, so please send me your questions and comments in the chat field of YouTube or LinkedIn. And please, when you do that, as we have audience from all around the world, please write the country where you are from so that we understand a little bit better your questions sometimes. As always, this session will be available for viewing on demand on our LinkedIn page as soon as the session is over. So today I have the pleasure of welcoming and hosting Yuvraj Narayan, who is the Group Chief Financial Officer of DP World. So Yuvraj is the group CFO of DP World, which is one of the largest global transport operators in the world, with almost 80 terminals in more than 40 countries. I'll just say a few words about him because he has a really outstanding career, and it's a pleasure and a privilege to have him with us. He has joined DP World in 2004 and played a major role in growing the company's global operations. And he also led the $21 billion of IPO of DP World, which was the largest IPO in the Middle East, together with launching some very innovative financing like Islamic bonds and also very long-term bonds in different capital markets. He has been instrumental in many mergers and acquisitions done by DP World over time as well. And I mean, his transactions that has participated is just an amazing list. I will not list them all, but just the first ever 30-year bond in the Middle East, partnership with large asset managers and sovereign wealth funds like the Canadian asset manager Caisse de dépôt du Québec, Russian, India, and other sovereign wealth funds. Out of all this, he has been named the MENA, Middle East and North Africa CFO of the Year in 4 occasions, 2008, 15, 16, and the latest one 2 years ago in 2018. And he also, not by himself, his finance team has also won multiple awards, including the best team of the year in 2015. And as a consequence of that and all of these, DP World is also a regular winner in the best company for investor relations in the Middle East. So without any further ado, it's a privilege to have you with us today, Yuvraj. And I'll start just by asking if you could just briefly tell us about DP World and your job as a CFO of this huge company.
Thank you, Professor, and very good afternoon to all those who have joined in. It's a pleasure to be here today. DP World is today a global supply chain solution provider for movement of cargo to all those people who own cargo. This is the today's avatar. DP World started in 2004. It's a Dubai-based company with one of the top 10 ports in the world, called the Jebel Ali Port and Free Zone. My own background is one, I was an investment banker right up till 1997, after which I moved on the other side, i.e. a real business. Needless to add, my experience and knowledge gained in my previous job was extremely helpful. And I don't think I could have done as many things as an investment banker as I was actually able to do as a Group Chief Financial Officer, responsible for finance, M&A, business development, strategy, and business in general. DP World, as I said, started with Jebel Ali, and we used to have, in 2004, we had 3 terminals. The Jebel Ali terminal, the terminal in Jeddah, and a management contract in Djibouti. Obviously, they had a very good rationale to become a global business. And the rationale at that time was reasonably simple. Shipping was a global business. and shipping lines were their customers. They had an outstanding track record for efficiency and productivity, and it was their customers who pushed them to take their expertise to other different ports in the world where they were not getting the same level of efficiency. And as you know, for shipping, if you keep a vessel in a port for 6 days rather than one, it has a very, very massive impact on shipping networks. If you're able to reduce 6 days to 1 day, they need 5 vessels less in a particular network and a string. So their investment is much lower, their returns become much better. And that was the reason why they said, look, if you can do for us what you're doing in Jebel Ali, in the preceding and succeeding ports, our capital investment would be reduced dramatically. And that's how this thing started. The rationale was that we serve global businesses locally. Why should we not be serving global businesses globally? We had established an enviable track record of efficiency. So for me, it was like a dream come true when I accepted this assignment with a mandate to make this a global business. And I still remember the chairman told me that in 5 years' time, I want to have a global business which is at least equal to the business we have in Jebel Ali. I mean, Jebel Ali was the 10th largest port in the world in those days anyway. And he said to me 2 more things. He said, this is your challenge. What I am giving to you is the asset we have. Don't ever ask me for money and don't ever ask me for guarantees. So your resource is the existing business. I still remember when I joined, there was an accounting firm which had done an evaluation for the port of Jebel Ali, and their value was $2 billion. Because they at some stage, they thought they should take just the Jebel Ali port public. And I think I sort of figured out pretty quickly that since I had dealt with a concession and how long it takes, the typical structure of building ports globally is essentially you go to governments, you seek concessions, typically tend to be anywhere between 25 to 40 years, and you build a port which you then have a right to manage and operate till the end of the concession period, at least. More often than not, concessions would get renewed. And I realized that each concession would take you 3 to 5 years. If you wanted to become a global player, it could take you 50 years to build the kind of network that DP World has today, in the sense of presence in 52 countries with 80 marine terminals and lots of other assets as well now. And so we, fortunately, got some good acquisition opportunities. And at that time, the challenge was clear. Where's the money, right? You only have cash flows from the business. And how do you securitize those cash flows to be able to buy more businesses? All I can say is, so this is 2004. By the early part of 2007, we had made acquisitions worth $10 billion. At that time, obviously, when we acquired existing businesses. We started first with CSX World Terminals and their terminal assets, and quickly went on 6 months later to buy P&O Ports. Both put together was $10 billion of investment. Now, obviously, we had levered ourselves because, as I told you in the beginning, this was pure acquisition finance. It was 5 years money. We had 3 banks underwrite it. Needless to say that my connections with the banking and investment banking industry was a huge help in raising this finance. I knew on day one that I would not repay this in 5 years. So very quickly, I had to find solutions to extend, the maturity profile. So I still remember me being asked this question that you've just raised the money. We just paid $100 million in fees. And 6 months and 9 months later, you're saying, I need to do the following things and you're going to pay fee again. I say, it doesn't matter. As the CEO of this company, I can't sit on a balance sheet, which I know is going to default in 5 years' time. I have to solve for this. So at that time, we decided that we would take this company public. We gave ourselves 3 years to do that. But in fact, the markets in 2007 were so hot, you could just about sell anything. At that time, for the first time ever, we raised $3.5 billion in a pre-IPO sukuk, where all it said was, we will do an IPO within a period of 3 years, right? And in that IPO, those who subscribe to this instrument will get a firm allocation. No preferential price, nothing. We went to the market with this instrument. It was the most deeply subordinated instrument I think ever written, where all it said was, when we do an IPO, if you are a holder of this sukuk, you will get a firm allocation. You will have the ability to convert this into equity shares of the company at a price that the market will determine at the time. So there was no preferential price. There was a preferential allocation.
Okay.
Right?
Right.
And just how crazy the markets were at that time, we were oversubscribed 5 times. We wanted to only raise $3.5 billion. So we took the $3.5 billion and we took 6.5, and we refinanced the entire acquisition package. And we raised 30-year debt for the first time from a Middle East company, and we raised 10-year debt. Again, so we were at that time post-acquisition of these 2 entities, CSX World Terminals and P&O Ports. We had 29 terminals across the world, evenly across all 5 continents. Our net debt to EBITDA was 6.5 times. And our rating was AA+. Okay.
Those were the times.
It begs the question. What have these things got to do with time? Okay, markets are crazy. There's too much liquidity. And that was the case in 2007 before it all collapsed in 2008.
Right.
But timing. So when markets are crazy, do whatever you want to do. Correct? Because incredible things happen. And we took long-term money. Our earliest maturity was 10 years later. 2008 markets collapsed. We were sitting pretty. I had $4 billion in the bank.
Okay.
In cash. I drew down every single finance facility I had when we knew that this crisis was inevitable. Because frankly, I didn't trust the banks. They would start canceling facilities. They would do all kinds of things to run away from whatever problems they might have. So we just drew it down. We drew everything down. Drawing down $2.5 billion from reputable banks over a 5-day period, no banker called me and asked me why you were doing it. Incredible, isn't it?
Incredible.
Anyway, but that's the way. That's the way timing and markets work.
We'll come back to this question on markets slightly later on. But let me now ask one question. I mean, you have a very privileged view on how basically the global trade and supply chains are changing. We've entered this massive world crisis that never happened, as we all know, basically the entire planet at the same time. Yeah. And many people are saying that the world is going to be totally different in the post-COVID times, where others say, no, I mean, what is going to happen is much more acceleration of trends that were already here. They are not new trends, they were here, but now we're accelerating some of these because the whole crisis made these trends go faster. I would like to hear your view on this. What are the key trends that you see being accelerated? And in particular, given your position, how is your view on global trade and global supply chains?
Okay, so you're absolutely right. I mean, all trends were visible. And the fact was much prior to COVID, which is what you describe as the crisis time. Trade wars had started happening. You saw most multilateral arrangements being questioned. You saw people moving away from established institutions and practices. You saw people wanting to renegotiate every written agreement. You had heard already, Amazon was there, Netflix was there, Tesla was there, Google was there, Microsoft was there. Artificial intelligence was being spoken of. And clearly, with lockdowns, people still had to continue to live. And what you saw is a massive acceleration of those trends. And one of the reasons why probably you don't see markets down 30% from an index perspective is largely because what Main Street has lost, Tech Street has gained. And therefore markets continue to be robust. Government responses have basically been around printing money to support livelihoods and to keep the liquidity on and to keep the financial system alive, right? To prevent massive defaults and renegotiations and restructuring. So all trends have been massively accelerated.
And if I can pick on what you were just saying, I mean, with basically, as you described, with ports and being one of the largest transport and supply logistics company in the world across all the 5 continents, what impact is this having on trade routes? For instance, you mentioned the trade wars, but beyond the trade wars, what do you think is the main changes in trade routes?
Okay, so as far as routes are concerned, the change will happen. It will largely be driven. I think the thing that is going to stand out the most is the decoupling from China. The overdependence of every economy on China simply will reduce. It will not go away because it can't, because the infrastructure that China built in 20 years, because of the fact that it's a command economy, it will take the rest of the world 50 years to build.
That's right? A very interesting observation. What do you mean by reducing? So do you see this already? Can you see this already happen?
Absolutely. The decoupling is inevitable. I mean, if you see what has happened to trade in, say, for instance, where will it move to? So 2 things were happening which were visible. The Chinese cost of labor in the 3 years prior to COVID grew at between 15 to 20% per annum. China was not going to remain the lowest cost producer in the world. You also saw China's strategy changing. Over the last 5 years, you saw Chinese businesses being pushed to go and manufacture and set up businesses for manufacturing outside of China to serve the world from there rather from in China. If you ask me, where did we see the maximum amount of competitive pressure, whether it was in LATAM, whether it was in Africa, whether it was in Asia, and whether it's Vietnam, Thailand, Malaysia, India, Pakistan, around almost entire Africa, Brazil, it was all China. So the thing is that the Chinese were moving out of China. And now the world is saying something slightly more complex. And that is that we cannot be dependent to the degree that we had become dependent on China to be the factory of the world. And now they are saying we also don't want to be dependent on what China controls.
Right.
Okay.
And
this is the subtle change which has happened as a result of COVID. That first China was quite successful because the rest of the world was sleeping. Europe was sleeping, US was sleeping, the developed world was sleeping while the Chinese were making hay, using their dollars to buy everything, to garner, to control natural resource, and start what I would say gently, economic colonialism.
And given what you're just saying, this some people also talk about reindustrialization and coming back to Western world. I mean, but overall, who is your customer and how do you see your customer changing? I know you've been working on a big transformation at DP World. It's not just a port operator. How do you see your customers, and basically how do you see this changing with all this acceleration of trends that we've been discussing?
Again, so what was happening over the last 5 to 6 years is you saw, first we were quite okay serving just shipping lines, right? There used to be 30, 35 shipping lines in the world, and those were our customers. We were not concerned so much on what was inside a container as much as we were concerned in just handling containers efficiently and effectively. What started happening 5, 6 years ago, because of massive overcapacity in the shipping industry, as they all, when prices of oil were at $140 a barrel, every shipping line, their P&L, the biggest cost line was fuel. Their entire strategy was moved around bigger vessels to reduce unit costs of fuel on a container. So huge number of this so-called 18 to 23,000 TEU vessels, is every shipyard. These were the vessels they were building. And it was all on the back of high fuel prices. Come 2008 and the crisis, and the price of oil, which now if you talk to anybody, they will tell you it will only be between $40 to $60. Had oil been $40 to $60 a barrel, these vessels would never have been built. Today, these vessels break even at 95% capacity utilization. I mean, how can that be a great business? So they realized that there was too much capacity, and you started alliances being formed, right? From today, you have 7 shipping lines. How can we, if we want to build long-term sustainable value delivery, ever have a great business if we have 7 customers? Also, we realized that we are the guys on the ground. My concession is on the ground. My asset is on the ground. I am sitting in the location where the owners of cargo are sitting, where either cargo is being manufactured or cargo is being delivered, right? My interest is, as long as these guys keep doing well and I make their business more efficient, my business will thrive. And so also, many massive number of middlemen were in the supply chain, doing nothing, providing itsy bitsy services and charging lots of money. With technology, they will be disintermediated. And we want to be the ones who disintermediate, right? So we want to serve. So what in a short and very easy kind of explanation, it was not going to be smart for me to just have shipping lines as my customers. I had to focus on what works for the owner of cargo and the aggregator of cargo.
Very interesting.
And that is why, so the thing that will happen and which will be massively accelerated as a result of COVID is the disintermediation of the middlemen in the supply chain.
Very interesting thought. Very interesting thought there, Yuvraj, on the disintermediation, and also, if I understood you, as you saw your clients who used to be the shipping lines concentrating from 35 or 40 to a handful. You saw that your profitability, that you would be squeezed, and so this move of going to
in life and in business, if you do not have leverage, you will lose. You have to continuously put yourself in a position where you do have a certain amount of leverage. People must have a reason to deal with you.
Oh, I like that sentence. I like that sentence. Very good.
Right.
Very good.
Constantly. So we used to think, great, these guys are building big vessels. If they could potentially, with small vessels, if they could call 100 ports, with these big vessels, they'll only be calling 15, and I have all 15. So I have leverage. Right?
Right.
Because that is, in effect, what happened. Ports get built once in 20 years, once in 30 years, and they get built for 100 years. Once you have, 10 meters of depth on your quay side, your quay wall can take that much of weight. Crane rails are designed with that much of width. They can take 50 tons of crane weight. Right? Now, these needed to go 10 wide, i.e. go across 10 containers on a vessel. And the vessels would go 5 high on deck. With 22,000 TEU vessels, they went 23 across, and they went 7 high on deck. You need new cranes. You need to redo your quay walls. It was not going to happen. So when we used to decide what ports we need to build, we used to go and do an analysis of what are the ships that are being built. A lot of the old ports, these vessels can't even go there. Right? So the whole dynamic of networks is going to change. And they built those big vessels to manage fuel cost. The most efficient way of putting cargo is take it from the place where it is manufactured and take it to the place where it is going to be consumed. Guess what? It touches 6 ports before it can get there now, because the vessels are so large that you can never take one point-to-point cargo across with a single vessel. And that is why the industry was great, because it used to grow at a multiple to GDP. For various reasons, if GDP grew at 2.5%, ports foresaw 9 to 10% growth. Why? Trade was not balanced. GDP is on the basis of a full container, loaded. When trade is not balanced, everything goes loaded east to west, half of it comes back empty. I don't care whether it is loaded or empty, I still get paid if I handle a container. Correct? That was the reason for multiplier. Everything would have to be handled 3 times. For GDP, it's counted once. For container throughput, it will be counted 3 times.
And right, we have a question here from the audience, basically, which was related to something you were talking about before on the financial market relation with DP World, and the question is related to your delisting in July. Apparently, you delisted earlier this year in June, as it said. Can you tell us a bit about your IPO and your delisting and the thought process behind the go ahead and the delisting from Nasdaq Dubai?
So the first prime reason you go and do an IPO to make equity an acquisition currency. When you need money, you should be able to raise equity and you should be able to raise debt. Equity never became an acquisition currency for DP World. In 2007, when I had 29 terminals, less than maybe $400 million of EBITDA, 6.5 times net debt to EBITDA geared, my enterprise valuation given by the market at that time was $27 billion, right? My EBITDA grew 8 times. My leverage became 1.9 times, and my enterprise value was significantly lower.
Can you explain that again? So you went from very high leverage and at
low leverage,
to low leverage, and you went from low profitability to high profitability, and your
market value, market cap was 50 to 60% down.
Okay, interesting.
Right? Now, I did not decide what my value was in 2007. It was a market discovery process. This is what investors were prepared to pay. My IPO was oversubscribed 4 times at that valuation, right? Then I found that we are a very active company. We keep recycling capital. We have beaten every single track record of growth across our industry. We have been number 1 across, whether it is growth, whether it is profitability, whether it is leverage, whether it is whatever. But our valuations were always discounted. Oh, but you are from the Middle East. I was from the Middle East, more from the Middle East when I did my IPO. So what's changed? Then, for some reason or the other, I think shipping lines have too much leverage on you. You won't be able to get. For 10 years in a row, I proved them wrong. But my valuation stayed where it was. It was never became an acquisition currency for me, right? When I recycle capital, so if I wanted to, we used to follow a strategy where we build only ports which are largely used for import-export cargo, not for transshipment. That's a lousy business. That's not a price-making business. And 75% of our business revenue used to come from origin destination cargo, and 75% of our volumes used to come from the emerging market world. Simple reason. Origin destination cargo is price-making cargo, and emerging markets will always grow at a faster rate than the developed world.
Sure.
So we used to chase long-term stability in revenue and high growth, right? And we did this for 10 years. Every time I recycle capital, i.e., I sold Australia, I got financial investors into Australia, they paid me 1.5 to 2 times the multiples that the public markets were valuing me at. And I did it for Australia. I did it for my assets in Hong Kong. And I realized that public markets actually don't give me anything. The equity listing gives me zero benefit. There was very little trading. We tried everything. We listed in Dubai, we listed in London, we had primary listings in both those places. 99% of the trading happened in Dubai. I offered to the investor, I will pay for you to trade my stock in London. I will pay. You will have no additional cost. They still didn't choose to do it. Then I delisted from London much before. Then ultimately, at the time when you're pursuing transformation, You cannot, this was doing nothing for me. I wanted to attract more equity investors into my business. But if I carried this rubbish benchmark of public market valuation, there would be massive dilution in my net worth of my shareholders. I could never raise equity to do anything I wanted. I didn't raise $1 of equity in the 11 years I was listed. Not $1. But I had no dearth of capital from private markets who valued me minimum. So I used to be valued, when I was valued at 12 times EBITDA in the public markets, I did the Australia monetization at 19 times. I did the Hong Kong value monetization at 16 times.
Do you think that's a signal that private markets, because many of the buyers in private markets are funds that are flooded with liquidity, right? Do you think it's the quantitative easing programs worldwide that that are partially responsible for that flood of money in private markets?
No, it is more about who wants long-term sustainable earnings. Public markets are very short-term in nature. Every asset manager is looking at his annual bonus. They churn things around, they change things around. The entire entire system. They want to keep things simple. They want to tell you how to run your business. Keep it simple so that I can understand it. Is the view. Well, my business is not simple. How can you say keep it simple? So when we decided to change our strategy, a lot of investors said, why are you doing this? We understand ports. I said, well, you need to re-understand ports. I'm doing it for a reason. I'm doing it because I don't think this is long-term sustainable. And they wouldn't understand it. So money is managed, public markets money is managed far away from where real businesses exist.
And so if I understand what you're saying, and this is something that I've seen happening, which is they were trying to put you in a bucket, right? In a bucket of comparables. And given the characteristics of the company, and given that you were actually moving your strategy to a more integrated value chain, as you explained before, they could not find a really good comparison to you, and they would discount you relative to others.
So for one, there was never a listed comparable, right? If there were Chinese ports at that time, they were just China-based. Who were my competitors? None of them were listed. So they did not have information from them. So they would say, okay, I will now compare you to this Indian port operator who's got 2 terminals in India. I said, hello, I have 6 terminals in India. I have 80 terminals worldwide. How is this comparable?
Right.
So in the absence of something that was similar, they would pick up anything and benchmark you. So essentially, we had to get rid of this rubbish benchmark, which was we were paying a price for listing. We had zero benefit, right? And that is the fundamental reason why we let this dinosaur get off our neck.
So we'll come back to this if again if we have time. But I want to just go through a couple of other questions we got here. One was related to what you were describing before on the supply chain providers, and they're both related. And it's do you think that supply chain providers only survive offering additional added value services to their clients, to their customers? And also, what's your view on freight forwarders? Do you want to basically kill freight forwarders?
No. So, we believe that everyone should. People get disintermediated when it becomes excessive, right? And I think that the supply chains have become both expensive and inefficient. And whenever that situation arises across any industry, disintermediation happens. I mean, when people got very expensive in Europe, those jobs moved somewhere else. They got either to get outsourced or companies insource and move all their people to a different location. Correct? This is similar. There's nothing new about it. It's a form of disintermediation. It only happens when massive inefficiencies develop. And with technology, it has become extremely easy, right? Like someone told me, okay, why would you not go and buy this freight forwarder? I said, are you crazy? The business is valued at $15 billion, right? It has no assets. It has a return on capital of 28%. You know why? Because it has no assets. Guess who has the assets? I have the assets. Why do I need to pay this kind of money? I would just buy 100 people for $50 million. Bingo. To develop the platform, it will cost me 200 million. Why the hell should I pay 16 billion? So all this, so there is this big concept, I mean, it has become fashionable. Asset light, massive return on capital, right? People have forgotten. What are there entry barriers to this business or not? What creates long-term value? Will you see this business 15 years from now? Any of these asset light businesses? Or are they going to have a 7-year run? And then something new will happen, something will change. There's no entry barrier to this business, right? And you see the asset light concepts, right? What happened to WeWork? What is Uber doing now? There is a Uber or a form of Uber and 3 of them in every major city in the world today. And today Uber is paying ridiculously high prices to buy competition to gain market share. 10 years, 5 years from now, the capital employed in Uber is going to include what they are paying for acquisitions to keep competitors away. See where Amazon has been investing of late. They're going to buy warehouses now. They're buying other companies. Billions of dollars are being spent. So what you thought was an asset-light business 5 years ago is not going to be an asset-light business 5 years hence, because they're going to follow the strategy of paying significant sums of money to retain market share in new markets where actually there is a form of Amazon that exists, whether it is in India, whether it is in other parts of Europe. They're just now it is. So somebody came up with a great idea. The great idea worked for 2 years in a particular geography. And then you saw similar ideas coming in other geographies, but he was a bigger boy than this guy. And he didn't want him to become big. So he paid silly money to get him. And then more silly money to get the third guy, and then more silly money to get the fourth guy. Because what are you buying? You're buying an idea, right? How do you know somebody is not going to come up with a smarter idea in 6 months?
I understand.
So the basic concepts of building for value, etc., have gone.
Okay.
And time will tell. The jury will be out.
Going back, a couple of questions are coming related to the delisting process. How did your board react? That's one question, and the other is basically, what is your relationship with sovereign wealth funds if they invest in infrastructure assets directly with you?
So we put up this proposal to the board that the listing had become a liability. The board was aware of how our internal valuation of our business was in terms of, so the difference was $13 billion versus $26 billion, right? The board was told, we have never used equity as an acquisition currency. The board was given examples that here are the 5 deals we've done on the private sector with private funds and sovereign funds and infrastructure funds, and these are our multiples. Now, would you like to be known as a 10-time multiple company or an 18-time multiple company? It was a no-brainer.
Okay, okay. And
that's as far as the delisting is concerned.
Right.
We have relationships. So I still remember this 5 years ago, or 6 years ago, we had access to public capital markets, whether it was for debt or it was for equity, right? We were a listed company. We had listed bonds. We had no issue ever raising money. However, we recognized that there is as big in size a private pool of capital lying with sovereign wealth funds and pension funds who had been giving their money to the asset management industry to manage because they did not have the same access to opportunity. We used to follow the nature of investments that used to be made. They were paying silly sums of money to buy assets. We saw them as our competitors in various bids, where they were consistently paying 20 to 25% more than we would ever agree to pay. We saw this happening for 5 years. Then we started going to them and saying, tell us, what is your experience? Oh, we thought we'd make 12%. I said, how much have you actually made? Across the board, 3 to 4%. Right. I said, my return on capital is 9. You come with me. I have access to every single opportunity, any place in the world. They want to see DP World as a bidder, right? So I have access to opportunity. If your return today is 4 times, mine is 9. You invest with me. You invest on the same terms that I invest in. I will not give you rights to tell me what to do. I will always put more money in a deal than you will. And that should give you confidence, right? If I lose, I will lose more money than you. And you will not believe it how long it took me to convince them, because what I was taking their infrastructure departments and silos out of work. I said, your issue is opportunity. You partner with me, you will see every single opportunity in this sector globally. If you don't want to do it, I may still do it. If you want to do it, so this is the deals I did with CDPQ, a case in Quebec, the pension fund, huge pension fund. We started simple, $3 billion, 55% is mine, 45 is yours, right? Those $3 billion got deployed over 2 years. Done. It's the best investments they've ever made. Today, 3 months ago, we increased that size of the joint venture to $8 billion.
Wow, fantastic. I guess you have more pension funds knocking on your door once this becomes public to co-invest with you.
Again, because we are saying to them that you will get the opportunity. This is the business we know. This is our track record. Here are our returns. It's open, it's visible. You make half the money when you do it otherwise. Why would they not come?
Very good. Very good. So, Yuvraj, first, thank you very much for this insightful talk where we covered lots of different topics going from the global supply chain to the changing world of capital markets and your experience both on the private side, public capital markets, private capital markets, as well as the global trade perspective. I think it's a very enlightening conversation. Thank you so much for this. I want to thank all of you here today with us. I want to remind you that this Building Forward series will continue. But first, I want to thank the IT team we have here and our alumni teams for setting this up. Our next event is going to be a panel led by my colleague Nuria Mas, and that will be in Spanish, actually, next Tuesday, 7 p.m. local time. And remember that today's session is available on demand on the LinkedIn page and on the YouTube channel for our alumni and the greater IESE community to watch at any time and share. Feel free to share this with anyone you feel is relevant and can appreciate. Thank you very much for joining us today, and take care.
Thank you.